PFR Nation, it is the most wonderful time of the year. That is right. It is Roth Conversion time. Come on, people. Let's get excited. Seriously, thank you all for listening to the last series, the 100 takeaways from 100 episodes. And truthfully, if you are new, if you are planning for retirement, and let's say you're over 50, you've achieved the 7-figure mark for investable assets for retirement, and you want to fire your boss very soon, or maybe you're already retired, I would highly encourage you, like I said, if you're new, to check out episodes 100 through 103, because I literally just did a little high-level breakdown of each of the episodes and one key takeaway from each of those. That way you can kind of get up to speed and a little familiar with some of my philosophies on retirement planning. One of the things that we talk about oftentimes, not only on this podcast, but with our clients on a day in and day out basis, are Roth conversions, okay? And you know how I feel if you've been around for a while. You know how I feel about Roth conversions. I'm kind of lukewarm on Roth conversions, okay? I'm not all in on Roth conversions like an Ed Slott, like convert it all, but I'm also not anti-Roth conversion either, okay? I think there are some folks that are defer, don't pay any tax, wait to the last minute to pay all the taxes. I think there is a blend, there's a happy medium, and it depends. It depends on many, many factors, but a big deal. In July, we had legislation passed, the One Big Beautiful Bill Act. I like to call it OBA. We're going to call it OBA throughout this episode. And there were many changes that OBA brought about. Many of them will impact you positively, PFR Nation. And I can say that with a lot of confidence because we've now finished all of our reviews with our clients, including our tax planning projections for 2025. And I'm telling you, most people I think all of our clients are saving taxes. Okay. I'm not going to say most people, but all of our clients are saving in taxes in 2025 relative to pre-OBA. And then certainly in 2026, very beneficial because the old tax brackets are not coming back anymore. So we know we have clarity on what the brackets are. Okay. However, there are a lot of folks out there that are talking about Roth conversions now because there are some specific changes, particularly for seniors, that have made the Roth conversion window a little bit wider, what I like to call the Roth conversion window. And truthfully, I think I made up that term, Roth conversion window. Okay, I'm seeing some people now on the internet talking about the Roth conversion window. I'm just going to go ahead and say, I don't know. I don't see any content, at least on YouTube, where people are saying the Roth conversion window before my episode. So I'm just going to say I made up the term. And truthfully, I did. I didn't steal it from anybody. But let me kind of set the stage on this one. What is the Roth conversion window? Okay, the Roth conversion window is essentially the time period after one retires. So kind of think about it. You're working, maybe you're in your peak earning years. Maybe you're in your 50s, early 60s. You're in your peak earning years, and all of a sudden you retire. Well, your earned income is going to go way down, maybe down to zero. Maybe that first year of retirement, you've got a little bit of income because maybe you retired in March. So maybe you have a 3 months of income. But either way, income goes way down to zero or very low. Maybe you're delaying Social Security for a period of time. Maybe you retired at 62 and you're eligible for Social Security, but you're going to delay it until 70 for reasons that we talk about on this podcast. Maybe you've got longevity. Maybe you have other assets that you can bridge the gap and let that benefit continue to compound up until 70. Maybe you're not receiving a pension right away or ever. And maybe most of your cash flow is coming from non-qualified assets, brokerage accounts, cash accounts, okay? RMDs, required minimum distributions, also have not kicked in yet. Those will kick in for you, most of you at 75, some of you at 73, okay? What a time where taxes are going to be very, very low. What I saw back in the day, early in my practice, because truthfully, Roth conversions were not very mainstream 16, 17 years ago, is that retirees would get very complacent during this phase. And then all of a sudden they would turn RMD age. Back in the day, like I said, it was 70 and a half. Then it went to 72, then 73. Now there's a combination of 73 or 75, depending on when you were born, the year you were born. But either way, once those RMDs kicked in, then it was the big tax surprise. It was like, oh my gosh, like Kevin, I don't even need all this income. I've got plenty of money in my brokerage account, my non-qualified account, or maybe I have nice Social Security and a pension that's paying most of your fixed expenses. And maybe they were taking some distributions here and there, but it was coming from the brokerage. They weren't even touching their IRAs or 401ks until that RMD trap kicks in. We call that the RMD tax trap, okay, or the tax trap of 401ks and traditional IRAs. This is the period of time in that complacency period where people need to really focus in on Roth conversions and whether or not it makes sense. That's why I call it the Roth conversion window. Okay. And there are plenty of reasons where you might want to get aggressive for Roth conversions. But I think, this is my humble opinion on this one, I think Roth conversions have become so mainstream now, okay, in the media, in content online, YouTube, podcasting, financial advisors, okay, and Roth conversions have become so mainstream. And you know how I feel about mainstream? I think mainstream, any kind of mainstream advice that's like everyone should do this, you need to take a pause and you need to really evaluate how it applies to you, okay? But I think a lot of folks are getting overly aggressive with Roth conversions now, and especially with the changes with OBA, okay? But, some reasons could make a lot of sense. Maybe reducing your lifetime tax liability, or maybe you're planning for the surviving spouse tax penalty. Maybe your spouse has a lot more longevity than you do, and he or she may live another 15 or 20 years as a single filer versus a married filing joint filer, assuming they don't get remarried. Maybe you have children with high incomes and passing on assets to them using the 10-year rule, not very tax favorable. Okay. Or maybe you're concerned about tax policy changes, and kind of thinking with the idea that, hey, someone's going to have to pay the bill when Social Security runs dry. We're going to need to increase taxes. So maybe taxes go up in the future. There are plenty of reasons, reduced RMDs, plenty of reasons to consider Roth conversions. Okay. But there are also plenty of reasons to not consider Roth conversions. Okay. But either way, today's episode, what we're going to do is we're going to focus in on some of the tax traps that I see, okay? And especially now with the new changes with OBA, I'm going to talk about some of these tax traps that I see day in and day out over the last handful of years that folks have been doing when they implement Roth conversions. And I hope you'll find this helpful. There are 8 of them that I put on this podcast list, but there are other tax traps, of course, but I'm going to focus in on these 8. So I hope you'll find value. And listen, if you are in that PFR Nation sweet spot, over 50, you've saved over $1 million, you're looking to fire your boss, you're looking to make work optional in the next handful of years, make sure to follow the podcast, and also make sure to subscribe to our YouTube channel. We're putting out weekly related retirement planning content specifically designed for you. Number 1, why don't we jump right into it with the senior bonus deduction trap? This is a new one for 2025. With the One Big Beautiful Bill Act. And this is why I wanted to do this episode, okay? Here's the gist on this one. You have 2 different types of deductions you can take against your gross income. You can either itemize your deductions. You can add in, your state and local taxes. You can add medical expenses. You can add all these deductions up. And if they mortgage interest, and if they exceed the standard deduction, then you're going to itemize, okay? However, with the Tax Cuts and Jobs Act passing in 2017, becoming law into 2018, not very many of you are itemizing any longer because the standard deduction was doubled at that point in time and has since been adjusted for inflation. The standard deduction now in 2025 is $31,500 for a married filing joint couple and then $15,750 for singles. In addition to that, there has been a senior deduction for folks that are 65 or older. And that's still intact. It's $1,600 for each married person. So if a married couple they're both 65 by the end of this year, they can get an additional $1,600 per person up to $3,200. Okay. If you're single, then it's $2,000 if you're 65 or older. So that was what we'll call that the regular senior deduction. But now there's the senior bonus deduction. And what this is, it's an additional bonus deduction of $6,000 per qualifying individual, qualifying taxpayer. So these qualifying taxpayers, who are they? They're the folks that are 65 or older by the end of this calendar year. So a married couple, if they both qualify, could receive an additional $12,000. So if you add the 12, let's use a married couple first. Let's use the 12 plus the 32 plus the 31.5. A married filing joint couple, even if they're not itemizing any deductions, let's say they had no itemized deductions, they can claim up to $46,700 as their standard deduction in 2025. Okay. You can see why most taxpayers are not itemizing any longer. Okay. And that will probably continue. I know there's some changes with SALT deduction. So maybe if you're in a high income tax state, high property tax state, maybe that changes. Maybe you are doing some itemized deductions, or maybe you are very charitably inclined and you're donating a lot. Maybe you have a high tax year and you're donating really aggressively to try to bunch your donations. in one particular year. Maybe you do itemize for a short period of time, but most people and most of you PFR Nation will continue to take the standard deduction. So this is very, very important. Okay. Now you can see why, because of this expanded senior bonus deduction, you can see why the Roth conversion window has now it's widened a little bit more. Okay. There's more room to do more conversions. And I think that's why a lot of folks, I saw a video the other day about, hey, because of the senior bonus deduction, now you can convert even more to Roth. And certainly for folks that are aggressively converting to Roth, absolutely, there's more opportunity. Okay. Yesterday we were just running a Roth conversion projection for a client that we work with. They've been doing Roth conversions for the last several years. Last year, they converted $51,000. This year, if they convert the same $51,000, their tax liability is going to be $2,000 less this year. And that's with Social Security going up for them. That's with their pension increasing. Okay. So you can kind of see the impacts of the One Big Beautiful Bill Act. They're going to have a lower tax liability by converting the same dollar amount. So it kind of gives them a little bit more room to convert a little bit more. But here's the trap on this one, is that the senior bonus deduction, that additional $6,000 per qualifying individual, does phase out based on your adjusted gross income. So for singles, it's $75,000. For married filing jointly, that's $150,000. So each dollar above that you earn over and above those thresholds will begin to phase down that senior bonus deduction up to $175,000 for singles and then $250,000 for married couples. So my caution to you is this: watch those conversions this year and then through 2028. That is the year in which the senior bonus deduction is set to expire. We'll see what happens. My crystal ball tells me that in 2028, they're going to continue that, because that's a very popular, there's a lot of baby boomers out there that are going to be 65 or even Gen X. What? No, not yet. Gen X only 60 this year. A lot of baby boomers, younger baby boomers that will be 65 or older. They're going to like that idea of continuing that senior bonus deduction. So my crystal ball says that'll get extended past 2028, but who am I, right? 2028 is the end date right now with the senior bonus. So just watch out for those conversions, because you need to weigh the cost of doing those conversions if you are going to creep up into those phase out amounts to see the impact on your senior bonus deduction. Okay. That's it for number one. Number two, the Social Security tax torpedo. Okay. So this is a good one. Now, contrary to what many people have been saying over the last 6 months, there was no change from a tax standpoint on Social Security. Like, I know Trump, he ran on making Social Security tax free. It just didn't happen. It didn't pass in the final bill. Okay. And I know a lot of people have issues with this because it's like double taxation. You're like, you're taking money out of my paycheck, right? In my working years, I have no control over those funds. And then in retirement, then you're going to tax that income when it comes out again. That's kind of double tax to me, right? I'd rather just give me the whole, don't even take Social Security out of my paycheck. Give me that money. I'd invest that myself. And I think I can earn a little bit higher rate of return than what the federal government could provide. But that's not how it works. Payroll taxes that I'm paying currently, that you're paying if you're still employed, those payroll taxes are directly funding Social Security recipients today. That's how it works. Like, there's no side pool that's growing and all of a sudden that this pool of money, it becomes, multiple trillions of dollars that's being paid out in benefits. That's not how it works. There is a Social Security trust fund to help true up any shortfall, which right now we do have a shortfall, and that trust fund is set to go away in 2033 unless something changes. Okay. But either way, bottom line is Social Security is still taxable. However, it's not all taxable. Okay. And you could have 0% of your Social Security taxable, upwards of 85% of your Social Security taxable. And the way the IRS is going to calculate how much is taxable is by calculating something what's called your provisional income or combined income. The basic formula is you take your adjusted gross income, not including Social Security. Okay. So add up pensions, annuities, taxable interest, capital gains, add up all of your adjusted gross income, not including Social Security. Then you add back any tax-free income you may have received. Maybe municipal bonds. Maybe you're trying to play that game with tax-free income there. Maybe you have foreign income. You need to add that back. Okay. Then you need to add 50% of your Social Security income. And that's going to give you the provisional income or combined income. Okay. And then that combined income is fed through these different tiers to determine what percent is at 0, 50, and then up to, again, like I said, up to 85% of that provisional income could be included in taxes. So yesterday, as an example, we were running a projection, that couple I mentioned, of converting 51,000. For fun, we ran a projection for the $51,000 conversion, and then we also ran a projection for the $0 conversion. Okay, because this is a perfect example of the tax torpedo, the Social Security tax torpedo. So the provisional income was super low before conversions. Like, it was so nominal because they have Social Security income, okay, but only half of that's included in the provisional income calculation, and then they have pensions, and then the rest they're just taking out of cash withdrawals, etc. Now, their provisional income was so small that the amount of tax on their Social Security was so low. I can't remember the exact combined amount, but it was, I think it was around the 15% level. Only 15% of their Social Security was taxable. But then adding that $51,000 conversion, because of this tax torpedo, it torpedoed more of their Social Security into higher tax brackets. So instead of just adding $51,000 to their taxable income jumped by $84,000. So an additional $34,000. Why is that? Because their provisional income increased because of the Social Security brackets, the way this is calculated. So bottom line on this one, I don't want, a potential additional tax on your Social Security benefit prevent you from doing conversions, but you probably want to know what the cost of those conversions are, the true cost of those conversions. And bottom line is, Roth conversions will increase your provisional income, which means it may not only trigger taxes on the conversion, but it might trigger additional taxes on that Social Security, potential double hit. All right, number 3, ACA subsidy cliff. Okay, so this is ACA stands for Affordable Care Act, Obamacare, healthcare.gov. I use healthcare.gov. And it's a big, healthcare in general is a big point of contention for early retirees, and rightfully so. You're not eligible for Medicare, so you need to figure out a way to get health insurance. And if your spouse, or if you're not married and you have no spousal coverage available, you're going to need to figure it out privately, okay, or on the exchange, which I guess is private. Here's the deal. ACA is out of control. I talked about this. I don't remember which episode, but I talked about it actually might have been on a YouTube video that I did, because at the end of 2025, the cliff is coming back. And I'm going to talk about what that is in a second. Now, in 2021, with everything going on with the pandemic, there was legislation that essentially extended premium tax credits. So kind of the high level 30,000 foot view, if your modified adjusted gross income is low enough, okay, and it's between 100% and 400% of the federal poverty line, you will receive premium tax credits. And that's how it's always been since Obamacare came into law, 2012, we'll call it. That's always been the case. But in 2021, because of the pandemic, there was extension, there was additional premium tax credits, even if your modified adjusted gross income was above 400% of the federal poverty line. And that was set to expire at the end of 2025. And I mean, truthfully, this was a big part of the shutdown just recently, is that Democrats wanted those to be extended through 2026. And, Republicans didn't want that. They said, no, we've already extended these premium tax credits for years. Pandemic is over. We're going to go back to the old rule, which is essentially a hard cutoff. Once you earn $1 above 400% of the federal poverty line, no premium tax credits. Okay, makes sense to me. That was the original rule. That was the original intent. It was set to expire in 2025, and it's now expired, or it's now going to expire in 2026. And if you're interested in learning more about how, like a little bit more in detail about how those premium tax credits work, I did a YouTube video. Maybe we'll link that in the show notes, but check that out. But I talked about this one in that YouTube video, is that I was predicting a substantial increase in health insurance costs, because we have a health insurance issue in America. It's a big problem. And I don't know if Obamacare has really helped anything, truthfully. Yes, it extended folks that were pre-existing conditions, that were typically not able to get policies. No problem. However, that comes at a cost. Okay. And now we're starting to see those costs trickle in to everyday healthcare costs, and including premiums. So I just did a projection on my 2026 health insurance premium. If I kept the same exact plan, Blue Cross Tennessee, shout out Blue Cross Tennessee, my premium is going to go up 60%, over 60%. Okay. Instead of paying $2,000 a month, I'd be paying $3,700 a month. Insane. That's more than most people's mortgage payments. I can promise you that. So either way, listen, my point is this, not to go on a soapbox about my insurance premium, but either way, if you're an early retiree, you're probably looking at these projections as well. With your health, the sticker price on the ACA pretty high, especially if you want a gold or platinum plan. Sure, you can go with the bronze or silver, but I just, from my personal experience, those networks are terrible. Most doctors don't want to deal with that. So most likely you might trickle into those gold plans, and the sticker price is just insanely high unless you can get some premium tax credits. That's what we're talking about here. And so next year, you must stay within that 100% to 400% of the federal poverty line. 2025 is the final year you can still be in the gradual slope. Okay. So again, I did the whole calculation on that YouTube video. Check that one out. So 2025, you're good. The cliff is not back yet. It's going to come back next year. So I guess this isn't really a tax trap for this year. It's more of thinking through next year, thinking about really, again, if you are on the ACA and you're buying insurance on the ACA and you're projecting forward what your potential premium tax credits are going to be, you need to be pretty conservative. You need to account for capital gain distributions or taxable interest or pension income, Social Security, et cetera, et cetera. Roth conversions are a part of that equation as well. So think about that. This could be an opportunity, 2025. If you are ACA, getting premium tax credits, maybe this is your final year of doing Roth conversions for a while until you get on Medicare. But again, it's not really a tax trap for this year. It's more thinking through 2026 and the impact on those premium tax credits if you're using one of those policies. All right, number 4, IRMA, income related monthly adjustment amount. If you don't know IRMA, okay, if you don't know IRMA yet, maybe you're an early retiree or maybe you're 65 or older and not subject to IRMA. IRMA is like the tax boogeyman in retirement. It's actually quite entertaining. Like, actually, no, I'm not going to say entertaining, but it is amusing how many people go out of their way to try to avoid IRMA. And I get it. It's like you've paid a certain amount into Medicare. Okay. So IRMA is related to Medicare. You paid a certain amount in for Medicare. When you go on Medicare, you expect a certain premium, but then all of a sudden you learn that, once your modified adjusted gross income are above certain thresholds, you're going to be paying a surcharge, which is essentially a hidden tax, a surcharge on Medicare Part B and D. And this could add up. I mean, there are different tiers. There are 5 tiers for IRMA, and it could add up upwards of $9,000 a year per person. That's $18,000 for a married couple for additional surcharge taxes for Medicare because of your income is high. Now, the tax trap I want to point out is that IRMA is based on a 2-year look back. So for 2026, IRMA calculation. So if you're going to be on Medicare in 2026, you may or may not be subject to IRMA, but they're going to be looking at your tax return 2 years prior. So in that case, they're going to be looking at 2024's tax return. So if you did conversions at age 63 and you're subject to IRMA in 2026 because of that, that would be your age 65. So I guess for 2025, that is going to determine your potential IRMA in 2027. We don't know what those brackets are today, obviously at the end of 2025, but you could maybe inflate the current IRMA brackets and kind of inflate those maybe at 3% a year. If you want to be conservative, maybe even do a little bit less, maybe do 2% a year to see what those IRMA tiers look like and try to play that game. Because Roth conversions are included in that modified adjusted gross income calculation, of course. So any Roth conversions you're doing in 2025 will impact IRMA potentially in 2027. So keep that in mind. I will point out just a little nugget on this one. I did a YouTube video last year on this one. I might do another one at the end of this year, but you can appeal IRMA. Okay. If you've had a qualifying life event, you can file SSA-44. It's essentially a form you fill out, send it in, Social Security. And there are several qualifying events, but one of those is stopping work or work stoppage, which is essentially retirement. And you could say, you know what? I would have been subject, or I should be subject to IRMA in 2026 because my employment income was so high in 2024, but that was the last year I worked. I didn't work in 2025. I'm not working in 2026. So therefore my income is much lower, and you can show them, hey, this is what my income is probably going to be in 2026. And they can decide to waive IRMA for you in 2026. So again, you must have a qualifying life event happen in order to file this appeal, but it's definitely possible. We've had several clients do it, and one client did it successfully this year. So check that out if you think you are eligible for that appeal. All right, number 5, The capital gains phantom bracket trap. All right. So one of the beauties of the taxable brokerage, one of my favorite accounts for retirement, maybe a better term is non-qualified account. I was actually having this conversation with a prospective client yesterday. It's like, what's the deal with taxable brokerage? Like, all of my accounts are brokerage accounts. My IRA is brokerage. My Roth account's brokerage. A little confusing. I agree. So maybe we can call it a non-qualified account. I actually like that term anyways, as opposed to like a qualified account, 401k, IRA, et cetera. So the benefits of a non-qualified account is that you're going to have more favorable tax treatment for capital gains, long-term capital gains versus ordinary income. Now, that will apply if you held the assets that you're selling at least 1 year. Okay. If you don't sell anything, you're not going to pay any taxes unless you own tax inefficient investments in that non-qualified account, which that's another tax trap. That's a little bonus one on this one is really review your funds, your investments in your non-qualified accounts, because end of the year, you might get hit with a little phantom capital gain. You didn't sell anything, but they're going to distribute a capital gain to you because maybe the fund sold out of some positions. They're actively managing the portfolio, and they're going to pass on those taxes to you, the shareholder. So don't own tax inefficient investments in your non-qualified account. Own those in your qualified accounts. Own tax efficient investments in your non-qualified accounts. But either way, if you sell something, you held it longer than a year, you're going to have long-term capital gains treatment. Okay. Which the brackets are 0%, 15%, and 20%. However, if your taxable income exceeds certain thresholds, that's going to push your capital gains into the next bracket, okay? And potentially even trigger what's called net interest income tax, which is an additional 3.8%, again, thanks to Obamacare. So before a Roth conversion, you're really thinking about, okay, you're in this early phase of retirement, you want to do some tax gain harvesting and maybe even trying to harvest some gains at 0%. Be careful with that, because that conversion might push your income into that 15% capital gain. So instead of paying 0% on the capital gain, now you're paying 15%, or even trigger that additional 3.8% net interest income tax. So just be careful with conversions and how they impact your taxes on long-term capital gains, because long-term capital gains, especially early in retirement, could be very, very beneficial, again, to keeping those ACA premium tax credits high, keeping your modified adjusted gross income down. So keep that in mind. All right. Number 6, state income tax trap. So this is for all of you living in high state income tax states. Listen up. Listen, if you plan to move to a no or low income tax state in retirement or shortly, you might want to really strongly evaluate that Roth conversion strategy and the timing of those conversions. So let's say you live in New York City, and all of a sudden, Madami is elected mayor, and you want to get out of there. You want to retire, and you want to move to Florida, or maybe my state of Tennessee. And you're like, hey, okay, this is going to happen in 2027 or 2028. Maybe you're doing some planning, but maybe you're already retired and you're starting to think about conversions. Well, just evaluate this. Think about the conversions and the timing. Do you want to do those conversions while you're in New York and you're paying not only federal income tax, but also state income tax? Or do you want to wait to do those conversions for when you move down to Florida, move to Tennessee, or whatever state you're moving to? Okay. Now, what's nice about the OBA passing is that we know that the tax brackets are made permanent. So I think it's safe to say that we know the federal tax brackets are going to be what they're going to be for the foreseeable future. Okay. I don't see it. It's definitely not going to change while Trump's in office. I don't see a president in the short term, probably the next president after Trump, changing the brackets. Now, kind of fast forward, looking into that 2033, 2034 timeframe when the Social Security Trust Fund goes away. Do they do that with federal income tax brackets? Do they increase the Social Security wage base? That's my prediction. Do they cut benefits? I don't think so. I don't know what they're going to do, but a solution needs to happen. But either way, we know what the federal income tax brackets are going to be. So I don't think there should be a huge rush to say, I need to convert now because tax brackets are going up next year in 2026 with the tax cuts expiring. We don't have to play that game anymore. We know what the brackets are going to be. So now it's the state brackets that you're going to look at. And if you plan to move to a no or low income tax state, you may want to delay those conversions until that happens. Not saying don't do any conversions, but maybe you kind of temper those conversions just a little bit. You maybe taper those down just a little bit until you move to that no or low state income tax state. All right, number 7. This is a good one here. Underpayment penalties and quarterly tax payments. So while you're working, especially W-2, you're probably used to paying taxes through deductions. Like you're just withholding some income and you're paying the feds, paying the state. No big deal. And then you file a tax time, you trip your tax bill, you're good to go. But when you're retired, especially early on, it's kind of like the wild, wild west. Like there's no like specific place you are required to withhold taxes, especially if you're not collecting any Social Security yet or any pension, right? Maybe you're just taking distributions out of your brokerage account or, distributions out of your cash account, not brokerage, non-qualified account. Maybe you're taking distributions out of a money market account or high yield savings for the short term, but then you plan to do some aggressive Roth conversions. Okay. The trap is that if you subject to underpayment penalties now, you might be paying a pretty good chunk of change in underpayment penalties. Several years ago, the underpayment penalty was like next to nothing. So it wasn't that big of a deal. Now I think it's upwards of 7% on the underpaid amount. So that is a significant little hidden tax that you just don't need to pay if you plan properly. You could file quarterly payments. You could do a tax payment directly from your IRA. So maybe you are, planning to do the conversion around this time of year and you don't withhold any taxes, but then you do a conversion where 100% or a withdrawal where 100% of your taxes paid from the IRA. That actually spreads out that tax payment evenly throughout the year. Okay, believe it or not, there's a little bit of a trick there. And then the nice thing is you can roll that money back in. If you have cash on the sideline, you can roll that money back into your IRA via the 60-day rollover rule. Okay, but the key is pay quarterly, withhold from proper sources, and at least meet that safe harbor. The safe harbor rules. Get familiar with the safe harbor rules so you are not subject to those underpayment penalties. Consult with your tax professionals, consult with your financial advisors. Do this the right way because we've seen this happen time and time again. And now that the interest penalty has gone up now to, I think, again, 7%, it's a little bit more relevant than it has been in years past. Okay, number 8, last but not least, is the FOMO trap. All right. So FOMO is real. Fear of missing out. For those of you that don't know the acronym. And the hype around Roth conversions is real, especially over the last, I'm going to call it 6-7 years. And, you may kind of feel this need to do conversions because everybody else is doing it. All the cool kids are doing the conversions. And like I said in the beginning of this podcast, I'd just take a pause on this one. And I would think about why Roth conversions might be beneficial to you. But on the flip side, I might think about why they may not be beneficial to you. Okay. In fact, if you need help with that, I did an entire episode with 7 reasons not to convert your IRA to Roth. I believe it's episode 66. Go check that one out. We'll link it in the description as well. And listen, if you're planning for retirement or you've already retired and you're trying to figure out, okay, how does this Roth conversion strategy fit into the context of the rest of my retirement plan, your income strategy, your investments, your legacy plan, insurance, all that good stuff. We do this day in and day out. This is what we do for our clients. So if you're interested in learning more about working with our firm, visit our website, imaginefinancialsecurity.com. Again, that's imaginefinancialsecurity.com, or you can start with the retirement readiness questionnaire that is linked in the description. We'd love to learn more about you, see how we can help you plan for and execute a successful retirement. That's it for today, everybody. I hope you all found this one helpful. And if you did, make sure to leave a 5-star review, Spotify, Apple Podcasts, wherever you're listening. I appreciate all of you. I'm thankful for all of you listeners. And we're looking forward to another great year in 2026. But let's finish off this year strong. Again, make sure to tune into the YouTube, subscribe to the YouTube channel. We're also putting out weekly videos there as well. And I guess we'll see you next week. Happy Thanksgiving to all of you. Hope you all have a great time with your family, able to watch a little bit of football and maybe relax a little bit. Yours truly, my 2nd year in a row, I'm going to be doing Thanksgiving to go. Okay, it's a little bit of a cop-out, I know, but we did it last year because we were in the middle of a move and it was just really chaotic last year. But doing Thanksgiving to go, it was like the most relaxing Thanksgiving I've had in many, many years. Okay, because I'm used to hosting and doing a lot of the cooking, my wife and I. So this year we're going to be doing the same thing. So I don't know when we're going to go back to actually cooking again because it's the same price. It's the same cost and I'm saving my labor. Okay, I don't have to worry about it. I can just kick back and watch football, hang with my family, relax, and enjoy the conversation as opposed to stressing in the kitchen. But don't get me wrong, I do love smoking my turkey. I don't know if you all are doing fried turkeys or smoked or oven roasted. I'm a smoked turkey kind of guy, and I'm telling no one can touch my smoked turkey. So I'll be back one of these days. But right now for 2025, Thanksgiving to go. Thank you, Black Creek. All right, guys, I'm gonna roll out of here. Thank you for tuning in, and I'll see you next week. Bye.